A retailer with long property leases thought performance was steady in difficult economic circumstances. Then FRS 102 changed. Rent expense became depreciation and interest, and leases hit the balance sheet. EBITDA went up, but profit dipped, triggering a difficult chat with senior management on their bonuses. These have historically been paid based on EBITDA performance.
That's the new on-balance sheet lease model being incorporated into FRS 102. In this episode, we'll explain what's changing, how this may impact your business, and how to get ready. Welcome to Business Talks, a podcast by Safri. I'm Tom Alun-Jones, joined by my co-host, Zoe Thomas.
Hi.
And today we have a special guest, our technical and training partner, Anna Hicks.
Hello.
As always, we're here to provide practical tips on the topical issues to support businesses and their owners. Don't forget to subscribe on your preferred podcast platform. In our first episode of 2026, we're talking about the upcoming changes to FRS 102, the UK accounting standard. They're designed to enhance the quality and consistency of UK financial reporting by aligning more closely with IFRS, particularly on revenue and leases, as well as increasing the required disclosure for small entities. These changes have been known about for some time, and given the technical nature of this topic, Anna and her amazing team have already covered the in-depth aspects on our website. You can find some useful links in our show notes. So today, our aim is to provide an overview on what's changing, how it may impact you, and what practical steps you should take now, hopefully without drowning you in jargon. Anna, can you give us the high-level purpose of the changes and what the regulator is trying to achieve?
Well, I think you already alluded to it's about enhancing quality and consistency of UK financial reporting. These changes are all about modernising UK GAAP. It's been a long time coming. So this reflects changes that were made to international standards, but they were introduced quite a while ago when IFRS 15 was introduced in 2018 and 16 in 2019. The FRC have been waiting in the wings to see how those went on for international companies, and now they're introducing this into UK GAAP. So this will modernise UK GAAP and it will bring us more closely aligned with international companies. So it will make UK companies much more comparable with other companies based in other jurisdictions. The way that I see it is a little bit like short-term pain for long-term gain. So it's going to be a bit bumpy in the first year or so, but we've got the experience of when this happened under IFRS, and we can see how this embeds into UK GAAP.
Thanks, Anna. And for those people who are wondering, when will these changes come in and who will be affected?
They come in from periods commencing on or after the 1st of January 2026. So we're into primarily it will affect December 2026 pairs of accounts. It does affect all of UK GAAP. So changes have been made to both FRS 102 and FRS 105, which is micro entities. So it's going to affect the whole range of companies from micro entities all the way up to large businesses reporting under UK GAAP. I think the FRC has estimated that it's going to affect about 3.4 million businesses in the UK.
Are these changes also incorporated into other reporters, for example, charities and LLPs?
Yes. So they are based on UK standards, but then there's usually an overlay of a SORP, whether that's LLP SORP or charity SORP. So that has been incorporated into the SORPs. So everybody will be affected in one way or another, but it will be slightly nuanced for charities and other specific areas.
Great, thank you. As we flagged in the intro, one of the headline changes is in relation to revenue recognition. Anna, how big a shift is this in practice?
I think on the surface, this comes across as quite a big change. So we're moving away from a fairly simple model of sale of goods or rendering of services to something that looks much more involved. So businesses will have to identify, there's 5 steps that they will have to follow, and it involves identifying performance obligations in contracts, which is something that we're not really used to doing under UK GAAP. I think that what will happen in practice is that it will be all about the timing of revenue recognition. But of course, that will affect some businesses more than others. But even though it looks quite a big change, I think for some businesses, which are very straightforward, so if you're just selling goods or you've got other just straightforward contracts, probably there won't be any difference. but you have to still go through the process of identifying performance obligations and seeing and documenting all your judgments to understand whether there is any impact. So even if it doesn't change anything, you still have to go through the process.
Thank you. That's useful to know. I guess practically speaking, businesses are going to have to review contracts, agreements, or engagement letters to assess the impact of the transition. What are we actually expecting them to do?
Well, the first thing is probably to make an inventory of all the contracts that are out there, and it's getting back to basics and looking and reviewing those contractual terms. There are some red flags that you might want to watch out for, and I think you would identify contracts that have those red flags and look at those in a bit more detail. So, for example, things to watch out for would be warranties. So whether that is a service warranty or whether it is something that could be purchased separately, or whether it's something that just brings it up to a set standard. And any other contractual terms such as customer options, options to purchase at a discount, anything in a contract that's got refunds, rebates, upfront fees, or sales with a right of return, anything slightly unusual like that would need quite close scrutiny by management to understand whether there's any impact to timing of revenue recognition.
And Anna, as you say, we're not really used to doing that because we've never had to do it before in such detail. Is that something that Safri can help clients with? And I suppose, is there a difference between what we can do for a client that is an audit client as opposed to one that isn't an audit client?
Yeah, that is an excellent question. As an auditor, we always have to be careful not to step over those independence lines. So I think it's really important that we can offer advice in terms of what the standards say, like a technical kind of, this is what the standards set out. But in terms of how that is applied to businesses and contracts, it's really important that we don't take on a management role. We have to maintain that independence. So it's important that management have a go at it first and document all their decisions. And then obviously from an audit perspective, it's like we're not marking our own homework. So we do need to be very mindful of that. Yes.
Thanks, that's really helpful.
I guess the other headline that we've been sort of hearing about, the bringing all the leases onto the balance sheet. Anna, what exactly does that mean? And what are the differences between what's coming in and what we have now?
There's a lot of talk about bringing leases on balance sheet. So we're not used to seeing operating leases on a balance sheet. So if you are a lessee, you just simply record an operating lease charge that goes through the P&L. It doesn't hit the balance sheet at all. Obviously, there would be disclosures around commitments. So we're moving away from that to the recognition of that lease, which involves capitalization of an asset and also a corresponding liability. So what you'll see is an asset that you can think of as like the value of the right to use something. That forms the asset, and then you have a liability that works the other way. The starting point is always actually the liability. So you start in calculating what that liability is, which is based on the present value of the lease payments. And then you use that as your basis to recognize a right of use asset. You add additional things in indirect costs and any restoration costs and any lease incentives. So your asset and your liability might not be exactly the same. But I think it's not just about bringing things onto the balance sheet. The other thing that we've got to be wary of is what actually happens to the P&L, because you would be depreciating your right of use asset, but your lease liability works a little bit like a loan. So you build up an interest charge and then the payments take that liability down. So in the P&L, you'll also see quite a big difference, which will be you previously had an operating lease rental charge. Now you're going to see depreciation and finance charges in the P&L. So it's not just about the balance sheet. Of course, that's probably where you'll notice the biggest difference, because your assets and your liabilities will both go up.
And I know, I suppose, because of that big change, and I know some will be used to this because it was similar to what IFRS 16 introduced a few years ago. But what do you think it will mean for businesses' operational decisions? Because that's a big change, shifting stuff onto the balance sheet and having an potentially extra charge to the profit and loss account.
Yeah, I mean, I think this is what businesses really need to do to prepare, is to look at actually what that looks like. So, for example, calculating ratios that are based on balance sheet figures, covenant compliance, anything that's a P&L bonus and profit scheme or share-based payments that are based upon particular results in the P&L, because all of that will look very different. The other thing to think about is that you're not allowed to retrospectively adjust your comparatives. So in the first year of adoption of this standard, you'll only put it through in the current period. So when you're comparing balance sheet with balance sheet, they'll look completely different. And so I think that operationally, that's going to need quite a lot of explanation for people, users of those accounts, to understand why it looks so different.
I've wondered, why has that been the case? Why do they not want you to go back and restate prior years?
I mean, for the revenue changes, you do have that option to go back and restate. I think it was just to make it easier. I think they were thinking that it would make it easier for preparers to actually implement it rather than having to go back and do a full restatement. In practice, I personally think it is going to look a bit strange.
Yes.
I think the other thing is that businesses will need to think about systems and controls. So do their systems gather the information that they need? Are they able to reflect all these adjustments into their financial reporting systems? So there is quite a lot to think about, and I do think it's going to need quite a lot of explanation.
Thanks, Anna. We've talked about the changes to revenue, leases, and also the knock-on impacts that business owners and preparers need to be aware of. So taking that all together, which industries are most likely to be affected?
Yeah, that's a great question. I think that one of the industries that is talked about quite a lot is telecoms, certainly from the revenue perspective, and any other businesses, like I said, that have got things like warranties or service elements attached to the revenue recognition, straightforward kind of retail sales, maybe if you've got discounts or point schemes. So anything like that will be affected. But in terms of leases, I think we do need to step back because it's not just a property thing. Most companies will have at least one lease. It'll usually be a property lease. But there are other things that we need to watch out for. Contracts that might not necessarily be called a lease, but actually they could be captured. So it might be something where there is a right to control an asset. So the asset is defined and they can control that asset in order to benefit from it, but it might not be called a lease. So something like the use of a particular server or the use of a wind turbine to generate electricity for something that they specifically need. So it's all about, is there an asset and are they able to control it? Another example might be a production line. Do they have some rights over a production line? So I think we do need to just think that it's not just a property thing. It could affect a wide range of businesses. Also, the only other thing is that some companies will be able to claim exemptions. So if all of their leases are short-term or leases of low-value assets, then there are exemptions in relation to those. So those won't have to be brought onto the balance sheet.
That's really interesting. And I think that from memory, the short term is less than 12 months. But the bit that interests me is the low value. How is that worked out? Because I think it's quite specific to the asset and the relevance of the entity. Is that right?
Yeah, so it's based on the actual value of the asset itself. They've gone about it a slightly different way under UK GAAP. So they've set out specifically things that wouldn't constitute low value assets. So that would be things like aeroplanes or big kind of production lines or vehicles. So we know that those are not included, but everything else is counted on an individual asset basis. So even if you have a portfolio of, say, laptops, you look at it on an asset by asset basis. So even if it adds up to a material amount, if you're just looking at the individual asset, that's what counts as low value.
Right, so we've talked about the leases and revenue changes, which are the sort of headlines that have been, I think, rammed down our throat in our sort of media over the last 12 months. But there are a few other changes that I want to draw out. What are the other changes that are worth drawing our listeners' attention to?
I think something that has kind of been slightly overlooked is these changes for small entities. So if you remember, small entities can apply what is known as Section 1A. So that involves recognition and measurement, same as full FRS 102. So they will have to adopt the revenue and the leasing changes, but it has reduced disclosures. So for small entities, they will have to increase the amount of disclosures around revenue and leases. But they've also slipped in some additional disclosures that small companies are not used to preparing. For example, they will have to disclose dividends paid, more about share-based payments, more about going concern. And then one that's slightly more controversial is related party transactions, which will fall into scope, whereas previously it was only material transactions that were not at arm's length. So I think that will be a shift for small entities, which they should watch out for.
That's good to know. I think that disclosure point is a particularly relevant one for basically a lot of our clients, particularly in the small company space. I think when we combine that with some other changes that the government has proposed around the company size thresholds and the potential disclosure to go on public record, Anna, how does that all kind of interact together for small businesses?
Yeah, it is quite complicated. Well, I'll try and explain. So essentially, the dates are not the same. So the government has increased the thresholds, allowing more small companies to fall within the small company regime, but the dates do not align with the changes in FRS 102. So the changes for small thresholds start on the 6th of April 2025. So more businesses may fall into that small threshold for the first year, and there's always a 2-year look back, but that's under the new threshold. So we may find that more small entities can take advantage of Section 1A. The difficulty is then when you bring in FRS 102 from the 1st of January 2026, and if you're bringing leases onto your balance sheet, that will increase your gross asset figure, which is one of the criteria used to determine company size. So it could be that you qualify as small, but then that might throw you over the gross asset threshold. But again, there's a 2-year look back. So it's going to be a little bit confusing for the first couple of years. So I think my advice would be to kind of look at it year by year and really hone in on that kind of the interaction between these two things. So the FRS 102 changes and the company size threshold changes.
Sounds like there's a few areas there where people might want to get in touch with either you or your usual Safri contact, because there's a lot to digest, a lot of dates, and a lot where you can get something wrong. So please do reach out. I guess, Zoe, given your area in tax, what are the tax implications of the changes that people should cover?
So they're probably far too complex for this session. However, at a high level, I think the main thing to focus on is deferred tax, both for the revenue recognition and the changes to the lease accounting. One is because on the revenue recognition, as I understand it, that is going through kind of as an opening adjustment, whereas for tax implications, all of the change for on transition is going through the tax computation in 2026. So that could be quite significant. It's probably a deferred tax asset that might want to be recognised, but obviously you've got to look at whether that can be depending on profitability, etc., etc. But the other thing on leases, you're saying that you're going to be spreading the payments over the term of the lease. That term could change depending on when the lease started and where it is in the profile of the lease from the 1st of January 2026. So there's quite a lot of work to do around that. And also you're changing the payments. So you're saying that it could have been an operating lease, so you'd be making rental payments, but actually now what's going through the profit and loss account is the depreciation and the interest, and you get tax relief for both. So although over the entire lease life the tax relief won't change, you're not going to get less or more, but the overall position was going to change in terms of what is recognised, how it's recognised. So again, it's deferred tax implications there. So I do think it's quite complex around the deferred tax for both changes. But then you've also got things like how will it affect, because you're changing the profit in the profit and loss account, and tax will impact on that. So what payment regime we fall within and the timing of the payment, the size of the payments, does it affect share-based payments? Does it affect CIR, interest deductibility, etc.? So there are a lot of implications in terms of tax, and as ever, they're never straightforward and will always depend on the situation that's facing the entity itself. However, we have given a bit of a summary on our website on the FRS 102 changes, the tax implications. And there's also quite a good summary in terms of kind of overall position on accounting, which is the changes to UK GAAP and how they might affect your business. So probably worth a look at those as well.
That does sound like another area where people might need some support. So please reach out if we can help you. I guess we've covered quite a lot there. We've covered some of the key changes, how that might impact the business, the tax implications, and some lesser known areas in FRS 102. In summary, what's the one thing businesses should do next? Let's start with Anna.
Oh, I'm not sure I can just say one thing. I think it is planning ahead and looking at those size thresholds, the FRS 102 timing at the same time. So I think it's having those discussions with the people that they need to have. So whether that's banks, whether that's key stakeholders, whether that's those charged with governance so that we can understand what those changes are. I know you said one thing, but the other thing is going and making an inventory. So we kind of need an inventory of all leases and all revenue so that when the auditors come in, you're prepared for what they're actually expecting to see. So I know that is two things. Probably I would say that you need to come and speak to us as well and make sure that you're involving your auditor in your preparations. I think that's probably enough.
Thanks, Anna. And Zoe, any final thoughts?
Very similar. It is definitely consult and think, plan ahead, probably some form of modelling as well, whether that is just to work out timing of tax payments, size of tax payments, as well as deferred tax for accounting purposes. So there's quite a lot to look at, I would say, but start sooner rather than later.
Right. Well, I think that's a wrap on our podcast for today on the upcoming FRS 102 changes under UK GAAP. Thank you to Zoe and Anna for joining me today. If you'd like further information or support, whether it's a contract review, a lease readiness, a tailored impact assessment, then please do reach out to us directly and we'd be more than happy to help. For information and insight, please do visit our website at safri.com. I know the presenters have mentioned a few articles that people might find useful. As always, the discussion is for information only and does not constitute accounting or tax advice. Please seek professional guidance before making decisions. Don't forget to subscribe on your preferred podcast platform and leave us a review. Thank you for listening, and we'll hope you join us next time.